Alright, good morning everybody and welcome back to a new video. So today I'm going to be showing you the different types of order entries that you can make while you're trading the markets. You probably heard of words being thrown out such as, stop orders, limit orders, market orders, and you probably are confused as to what they mean. So in this video I'm going to try my best to showcase to you the different types of market orders that you can use while you're trading and see how they can benefit you in terms of your risk management, in terms of how you're going to be entering a trade. So when we look at price, for example, this is the Australian dollar. We'll see that currently its price is at 0.6487 and 1 pipette. And you're going to see on top of it a couple of boxes. It's called ask and bid. Now the way the ask and bid works is, think about it like selling a vehicle. When you sell a vehicle, the asking price is the price the sellers want to sell it for. So in this case, it's selling for this number. It's on red. See where my mouse is. And the bid are like the offers that buyers are willing to pay for. Now, in between that range between the ask and bid is a spread. And inside that spread, when you do a market order, your broker is going to try its best to either fill you at a good spot inside that spread. Now, sometimes, depending on a broker that you choose, it's going to let you know how much of a spread their brokers usually offer. Usually it's like 0.1 pip or something like that. It's like really tight, and because everything's so computerized these days, not that you don't have to worry about it, but prices, your order does tend to get filled a lot quicker. And sometimes when it's really crazy days, like super volatile days, think of like red folder days, or some crazy event happens in some country. Those are the days where you'll see the bid and ask spread kind of like widen, and you might not get the perfect fill. So I'm going to bring your attention here to the right. This is TradingView's own position panel, where you can just write up how much you're willing to risk, your stop loss, your take profit, and all that. So you're going to see here on the top where my mouse is, there's the market order, there's the limit order, and then there's a stop order. So what we just went over is called the market order. So you literally, when you just want to buy something, you hit this button, and then your broker will try its best to fill you in between that bid and ask spread. So that's one. The next one I want to talk to you about is the limit order. Now the limit order is like it's like both the limit and the stop are like instructions that you're telling to your broker, letting them know that you have a specific price in mind in which you want to get involved in the market. Now, while it's also not guaranteed you'll get filled at that desired price, your broker does tend to, most cases, just get you filled at the price that you tell them to. There have been some instances where I put up a stop or a limit order, and it gets filled, but not exactly to the pip, but it still gets around the whole number. It's fine, as long as you have enough range for a stop loss, right? That's why stop loss is important. So in this case, for example, we're going to see this sell order hypothetical. The red box is the range from my entry. So this line in the middle represents my entry. You're going to see a gray box here. Then you see a red number. That's my stop order. So that's going to be the price in which I tell the broker, hey, you know what? Once it reaches at this price or above, get me out of this trade, automatically close it. Don't even worry about it, fam. But when it comes to the gray one, the gray number, that's the price I'm desiring to get into. And then the green box is my take profit. That's going to be like my entire goal for this trade idea. Now, when price is ranging like this, right? So this orange line will represent real-time price. Let's say it's meandering around and whatnot. And this is let's set this, for example, a limit sell. So price is down here, right? And then when I type in a limit sell order, I tell the broker, hey, you know what? Let me get at this level. Once price goes up to your entry, when it does this, it'll trigger your entry and you're in on a short now. As long as price doesn't reach above your stop loss, you're fine. You'll just be losing some money right for a moment, and if it ends up going your way, then you've got a trade. So again, uh, the way that limit sell orders work is that when price is below your order, you'll tend to get filled. If price is up here and you're trying to get into a limit order, it won't work. The broker will just deny your order. So it has to be in a condition where price is below your entry. That's when price will eventually, that's when your broker will get you, will cooperate with you and get your order filled. Okay, so that's a stop limit order. Now a buy limit order is the same thing, it's just reversed. So if you're trying to get on a buy limit order and price, keep in mind of the orange line, if price is below down here, it won't get you filled. Okay, your broker will just deny it. So until price, let's restart this position. So if price is hovering up above your order, right, and then let's follow the arrow, right, then it takes a dive into your order, that's when you'll get triggered on your buy limit. And then if price does something like this, goes back up, and you got yourself a winning trade, right? 3RR. I say it's 3RR because the risk to reward ratio is 3. So you're risking $1 to make 3. In this case, for example, I made this trade risk 25 pips and the risk to reward 75 pips. So in this trade, I'm looking to make 75 pips and just risking 25. Right? 25 times 3 is 75. That's my risk to reward. Now there is commissions and fees. Sometimes your broker will put you into those. We're not going to talk about that in this video. We're just talking about the types of orders. All right, and that's the limit order. So now we'll take a look at the stop orders, right? So now stop orders are the same thing where you tell your broker, hey, I want to get in at this price. This is my desired price that I want to be involved in the market. Can you fill me in? Broker's going to say, yes, I can. Or sometimes they will say, yes, we could, and then they fill you at a slightly different price. That's just the way things are, you know. Sometimes market volatility is just too crazy, but they'll try their best to get you filled. Sometimes you might not even get filled. See, that's the thing about setting limit and stop orders. Sometimes you might be too accurate on the number of your entry that the broker just won't fill you because it never really tapped it there technically. But now back to the buy stop orders. Now these are my favorite kinds of orders. These are the ones I like to get because there have been many instances where price does something like this. For example, it's pretend that it's downtrending and then it dips. Sorry, excuse me, let's say, there we go. So price is up here, then following the blue line, it dips way below I wanted to, like down here. See, if you would have gone there on a buy limit, you would have been cooked, right? Because then price would have triggered you and you would have been at a full loss right there. See that? But then price does something like this. Check it out. Oh no, how could I missed the trade? No, you didn't. Because if you set your order as a buy stop, you're setting up your buy stop to be triggered when price goes above your entry. See that? So when price is below down here, taking down this low, and you have a buy, you put in your buy stop order with your broker, they'll accept it. They'll accept it. If your order's down here and price does something like this, your broker will deny your buy stop. See that? So price has to be below your order so that it can accept a buy stop. So again, price will dip down, too much of a dip, and then it will just expand higher. And you set your broker up right then and there. Or, you know, when it was down here, you submitted your order to your broker and they were like, sure, we'll accept it. Now you're placed. Now when price does something like this, all of a sudden, now you're filled. And you made money. Isn't that great? That's the same thing with sell stops. Now we're going to take a look at a sell stop order. Price needs to be above your entry price in order to get into a sell stop order. So again, let's say price is down here, you won't get filled. Your broker will deny your sell stop until price goes up. When price goes above your entry, that's when they'll start admitting your self-stop order. So when that happens, you submit your order to your broker. I want to sell like this. Cool, we'll take it. Now price takes a dive. Now you're triggered. See that? We cross your entry. Now you're triggered. Now, as long as price doesn't go above your stop loss, you're fine. If it starts heading your direction, great. You're making money. You're making money along the way, and it'll close automatically because you set your take profit. So that's the way the market limit and stop closes. The stop orders, that's how they work. And again, that's just a better way to get into the market by letting the broker know exactly at what price you're willing to get filled. Of course, not everything's a guarantee. Price can just gap you over, meaning that it can just jump over your price and there will be literally no fill taking place. And these are real world conditions, guys. Like this, not everything's perfect here. So even if there's like a big major event, or for example, like a big earthquake somewhere, price gaps from this price. There's no trading here, and then it jumps up down to here. Then all of a sudden, starts doing something like this. If your stop orders here, and we literally gap above your entry, yeah, there's a low chance of you getting filled on that, to be honest. And this is why trading is so risky, right? When you sign up, you tell your broker, hey, listen, I'm willing to take on the risk. Okay, that's the paperwork. Now, what happens when you're, for example, want to get on a stop entry, but then price literally does something like this, get triggered, right? And then it's like, nope, I'll just keep going. See that? And then we gap. Uh-oh, it didn't touch your stop. We literally gapped above it. You're still in the trade. Oh no. Depending on the broker, they'll just automatically close you, or depending on how greedy or unregulated they are, they could just keep you filled. Because technically speaking, your price was never reached. So it can get really dicey if you don't know what you're doing. So it's very important to monitor your trades. Make sure that you have a good stop loss so you have enough range to know that you're protected. And that's just the way the business works, guys. So trade at your own risk. Of course, everything I say online here is not investment advice. This is just for entertainment. And so let me know what you guys think about this video. Please make sure to just give it a like, sub, whatever, do all that fancy stuff. And yeah, but if you're here for more, then I got one more thing to show you. So we are consolidating here in this range, right? We don't know what's going to happen, if it's price going to keep going higher or keep going lower, right? But what I'm trying to show you is that when smart money goes in there, they know that there's a lot of people with what? Buy stop orders above what? On the line of resistance. Because they think that this line is protected, maybe double top or something. Price is just going to shoot up and go up there. Something like this. Now, realizing that smart money will actually sell an old high, tap those people long, trick them, thinking that it's going to go up higher, and then, nope, we're just going in there to get more sell-side liquidity, sorry, not sell-stop, sell-side liquidity. So when resistance, smart money considers that as buy-side liquidity, so price will trigger up those stops to go up long. So boom, think of all the people who bought here on a buy stop. But nope, you know better. You'll sell it to the people who are willing to buy up there, only to go down lower. Let's do the opposite. So these are all the people who, in the form of sell stops, thinking that they're going to keep going down shorter. Think of the breakout artists, the people who want to sell short on a breakout. They think that price is going to go down lower, right? But no, that's not the case. Instead, smart money will buy as it's going down. Will buy from the people who are selling, then head up higher. And that's just something that I've been learning about So that's why it's called smart money, because you're trying to get into the trades that people don't want to. People think that's going to keep falling for the falling knife is what they say. But you're going to go in there with that logic, and you know that where there's old lows, there's sell stops resting down there. So you want to buy from those sellers, get in there on a buy limit or on a buy stop, and you're going to see price expand higher, depending on the market conditions, right? Whether we are on a buy program or a sell program. So that's a little bit beyond what I wanted to cover. I just wanted to hopefully help you understand the differences between markets, limits, and stop orders today. So yeah, all right, have a good one.